It is a completely normal Monday morning. The financial district is humming with the usual routine. People are buying coffee, the streets are calm. Then, a single, unverified rumor reaches one person. They hear their bank is in trouble. Without waiting to check the facts, they rush down to the lobby to withdraw their savings. Panic moves faster than the truth. Seeing one person rush for cash makes others nervous. Soon, dozens of people arrive, then hundreds. By the afternoon, the line stretches around the block. But what happens to the entire system if absolutely everyone wants their money at exactly the same time? Many people imagine that banks store all their deposited cash in a giant physical room, locked behind steel. This is a myth. Banks operate on fractional reserve banking. They keep just a fraction of cash to cover normal daily withdrawals. The rest stays in motion, loaned out to fund mortgages, expand businesses, and build factories, keeping the broader economy moving. The system is efficient because it functions as a moving machine. It depends entirely on the fact that customers will never demand all of their cash back on the same day. When fear overrides logic, that core assumption breaks. Thousands of everyday people rush the front doors simultaneously, aggressively demanding physical bills that are simply not in the building. The bank enters a liquidity crisis. While it holds millions in value, that value is locked in long-term contracts. A teller cannot hand a customer a piece of a residential driveway. To meet the sudden demand for cash, a bank is forced to sell those assets immediately. Buyers demand deep discounts, often causing the bank to lose more money than it has in its own reserves. The Great Depression remains the clearest historical example of this systemic failure. In the 1930s, panic moved at the speed of a crowd. Thousands of people waited for hours in the cold, wrapping around city blocks, hoping to reach the front doors. Inside, tellers physically ran out of paper money, forced to turn away families who had trusted them with their life savings. In 2023, the architecture of the bank had changed, but the math stayed the same. When Silicon Valley Bank collapsed, no one stood outside in the cold. Fear spread through social media, and customers used their smartphones to withdraw $42 billion in a single day. Technology changed the speed of the run from a walk to the speed of a Wi-Fi connection, but the structural weakness remains identical. If the system is this fragile, how does it survive day-to-day life without collapsing? Governments built layers of protection to stop rumors. Deposit insurance guarantees that even if your bank fails, the government will replace your savings up to a certain limit. Central banks act as the lender of last resort. If a bank faces a spike in withdrawals, the government can provide emergency cash to keep the vault full and prove the institution is stable. Regulations also act as structural reinforcements. They require banks to keep larger, monitored buffers of cash that cannot be loaned out. These tools are engineered to provide stability. They are designed to make the act of panicking unnecessary. Understanding these fail-safes reveals how the system is built to absorb shocks. Knowing your local insurance limits and distributing savings across different institutions helps manage personal risk. Panicking to save your money is often the very trigger that puts it in danger. Banks do not survive because they hold everyone's cash in a vault. They survive because we collectively agree to trust the system. What if one country stopped using physical cash completely? That's our next documentary.